also, of course, by the late passage of the 2016 budget was a factor. But on the government side, looking slightly ahead, of course, this government has an expansionary budget stance. Unlike others in similar predicament, it's rather than trimming its expenditure, it's ramped it up with a very heavy emphasis on capital expenditure. So our view, as we said, Q3 we're going to have more contraction, Q4 we think will be flattish. For the year as a whole we've got shrinkage -1%, and for next year 2% growth. People may say, why growth at all? Well, you have to remember that the population growth, of course, is above 2%, so 2% is nothing to get very excited about. The burning issue everybody in this room and elsewhere, of course, is the foreign exchange regime and the shortage of FX. So we have a chart here, but it only runs up to May. This is the CBN chart. This is the transactions through the CBN, inflows and outflows. And obviously you can see that the trend is going in the wrong direction. Since May, of course, we had the adjustment, devaluation, liberalization, whatever you care to call it, on 20th of June. And the flows are much, much reduced. Whatever source you look at what the FMDQ has to say, if you look at the Reuters screens, or even if you look, you get a very good example, a very good flavor from looking at the press coverage of how the banks are allocating their foreign exchange. You can see how much reduced are their allocations. You also see quite curiously who's allocating what to who, but it's a separate point. Now, of course, one reason on the central bank side, well, the reason the outflow, the supply is much reduced, of course, is that the main supplier is the central bank, and the central bank has an eye on its reserves, as any central bank would do. So we have two charts showing reserves. First one, this is reserves from the oil price. So, normally you'd expect to see a sort of correlation, both going in the same direction fairly closely. In fact, what you do see is that a modest reduction in reserves and a crash in the oil price, which probably tells you something about foreign exchange management. The second chart on reserves is just showing the decrease in the movement on reserves on a monthly basis. And even given the caution on the side of the central bank in releasing dollars, you can see the reserves are being depleted quite rapidly. So now we have here what to do next. So we have what we call the piecemeal solution, which is not the favorite solution because it doesn't mean immediate release and escape and rejuvenation of everybody, but it's a measured view. So we're looking at various ways to get out of the impasse. And the impasse, of course, is the need to create a large enough inflow from autonomous sources so that confidence returns and you will have what the experts call a fully functioning FX market. So how do we get there? Well, there have been various attempts and various proposals. The first one was monetary policy in the month of July. The MPC hiked policy rate 200 basis points. The idea solely was to bring back the offshore portfolio community. It didn't have much impact, so that's a no for that one. The oil price rescue. So will oil come to the rescue? Well, if you look at where we are in global demand and the oversupply and the fact that the fracking industry has not been brought to its knees by the Saudi and OPEC strategy, something tells me the rescue is not imminent. So our assumptions are basically no big improvement until the end of 2017, probably later. So no to that one. Asset sales. Well, there's been a domestic debate about a fire sale of state assets. The idea is that you generate enough FX to provide the trigger that we're talking about. Now, this debate is not initiated by the federal government, as the finance minister was at pains to point out to us yesterday. In fact, it's somewhat embarrassing to them. They're obviously looking at isolated asset sales, but they don't appear to have bought into the big program, and I can see why. One reason would be that you're selling from a position of weakness. Number two, there's the issue of who you're selling to, of course. And there's the third point would be that only six years ago, the Chinese oil company was reportedly offering $50 billion just for the NNPC stake in the unincorporated joint ventures. Now, the total being proposed in the current asset sale is all people's opinions, 15 billion. So would that do the trick? Our suspicion is it won't do the trick, and then we don't think it'll be approved. The program will be approved by the federal government. So in order to do the trick, as we call it, we think you have to clear the backlog, and you probably have to provide, being very conservative, let's say 6 months of input cover. So 4 billion per month times 6 plus the backlog. We probably think you need twice 15 to pull the trigger. We haven't completed the IMF issue. Now, Mrs. Lagarde, who, as we all know, is the managing director of the IMF, suggested at the autumn meetings that there would be zero interest money available for appear to be low-income or developing country borrowers. Now, Nigeria, as you know, has never drawn from the IMF, and if you look at its quota, which is 2.5 billion SDRs, roughly $3.5 billion, over time, it would have access to 4 times that, so that would take us to roughly $20 billion. But the fact is, the federal government's not going to take it. So that's another no. And then we have what you might call the Uber free market solution. The Uber free market solution is what the traders call letting it go. So basically what you do, you meet all demand, you let your reserves dwindle, and you hope autonomous funds will come streaming back into the Nigerian market. This is what we call the Uber free market solution. It's not one which we personally would recommend. It's fraught with risk, and on the surface looks very nice. So what we do have in its place is what we call the piecemeal solution, which means people have to be much more patient before we reach this fully functioning FX market. And the piecemeal solution would be a combination of several elements. So, for example, the Eurobond sale, I hope rather larger than mooted, which again the finance minister indicated was a possibility were the price to be right. So that would be one part. You could have one-off asset sales. Then there's been the talk of the advance oil purchase from the Indian authorities, which the Minister of State for Petroleum has mentioned. Then you might get some recoveries back, you have a better fiscal record, and you might even get some, and you would get to pick up an infrastructure financing. On the point of infrastructure, we'd just like to say that there's certainly room for greater use of guarantees on the behalf of the federal government. If you look at the DMO's data, you find the contingent liabilities, or the guaranteed part, the part which is loans, FX loans, guaranteed by the federal government at the end of last year, 260-something billion naira. So that then exchange rate, of course, not much more than $1 billion. So there's some room there, certainly. So this is what we're calling the piecemeal solution. This brings us quickly onto the fiscal side and what's happening there. Well, the point here, we all know that Nigeria is suffering because its Achilles heel. It didn't prepare for the slide in the oil price. It didn't create a large enough buffer, and it did not allow the ECA to become a sovereign wealth fund. So the result is, as in Russia, Azerbaijan, and many other places, when the oil price sank, and this time we've been at a low level for 2 years plus. Last time, 2008, 2009, we just had 9 months. So the pain was fairly inevitable. One thing the chart does show, of course, is in the most recent quarter shown the non-oil inflows in blue were actually larger than last quarter, but last quarter were larger than the oil in grey. So this is just a breakdown of where the non-oil revenue is coming from, and there's what a teacher will call a room for improvement, definitely in all categories. The finance minister says that there's been 700,000 more registrations of companies in the last 1 year, and along with many other measures taken on the revenue and expenditure side. So there's certainly room for improvement on VAT. There's the old question of do they increase the VAT rate? The IMF says yes, but the IMF's advice isn't very popular, so probably they won't do that. The idea is to increase, of course, the net of people who pay VAT. But scope for improvement here, certainly. Now, this chart it's not very artistic, but basically all the blue lines are up and all the grey lines are down. Blue lines, of course, are the expenditure. Grey lines are the FGN deficit. So we have basically a structural deficit with the FGN. We're showing very quickly here, this is the monthly FAC payouts. Now, you'd expect these, in the ideal world, these to be slightly more positive and reflect the fact that nominal collection has picked up. But actually, the key point to remember here is the time lag. So the calculation of oil revenues takes place is based on 3 months earlier. So, for example, the September figure for the FAC payout from the mineral or oil section was actually based on the June revenues. We know that June, of course, was a low point for the sabotage side.